platform, and that has helped us improve gross margins. There are some activities also which are supplier negotiations, better supplier management, as well as some contribution to because of the lithium prices being more stable. Now, looking ahead also, generally margins will be, like I said in my opening remarks, from here till about a year, we can assume incrementally improving. Some of that we might pass on as pricing tactically. That's a tactical call we take on a real-time basis or regional basis. But largely, the gross margins are a function of supply chain and the engineering from Gen 2 activities. Rishi, you want to answer the second part of the question?
So on the so you can repeat that question, Kapil?
So I just wanted to check. We called out that there was about 8% PLI and 6% FAME, if I got that right, in 1Q. What were the comparable numbers in 4Q?
So if you look at the 4Q numbers, the PLI we had on two products. So our S1 Air got certified for PLI in December.
I think it's broadly similar, right?
1-2% because FAME was higher.
Yeah, FAME would have been slightly higher.
Yeah.
And actually, net the incentive of 13-14% combined would have come down in Q1 over Q4.
Yes. Yeah.
Got it. So Q1 incentive you are saying is lower than Q4?
Because FAME reduced in Q1 over Q4, right?
Understood. And just lastly, if you could also comment on, we are talking about the new cells which will start contributing from Q1 FY26. So what is the capacity of cells that we plan to start with? And which technology they will be based on? And in terms of EBIT margins also, will they lead to an improvement in EBIT margins once you start cell production? That's it from my side.
Sure. See, the cell production is starting Q1 FY26. The installed capacity right now is 1.4 gigawatt hour. That is roughly equivalent, if you assume a 3 kilowatt hour average in the vehicle, that's about 500,000 vehicles. So that's roughly our current volume today, give or take a little. So when we start integrating our cells into our vehicles, there will be a ramp-up period. Not all products will move on day one, but over a couple of quarters or so, the 4680 cells will be replacing the 2170 cells in all our existing S1 products. New products which start after the cell production will actually on day one start with the 4680 cell itself. In terms of cell chemistry, our cells, the 4680 is actually a platform which can support multiple chemistries. The first chemistry will be an NMC chemistry because that's what our scooters are based on. Eventually, in about, let's say, couple of years or so from now, we will come up in the same platform with an LFP and an LMFP chemistry also. And maybe sometime in the future we'll publish a cell chemistry roadmap from our side. Today we don't have it published. So we will be, this platform can actually support, and that means our whole manufacturing investments can support both type of chemistry, NMC and LFP, and their individual family derivatives like LMFP or LFP.
And on the EBIT margins also, if you can comment, will they also see an improvement as we start with our cells?
So let me just give you the headline on the cell. So on the financials of the cell, see, the cell costs are about 1/3 of the vehicle costs right now for us, roughly, rule of thumb. Now, as we look ahead into our own production, as we start producing it, we will be saving some of the margin that a global supplier like an LG or whatever global supplier would be making on that cell, as well as there's a cell import duty also, we will be saving that. So it will slow down into gross margins, and at a certain scale, it will slow down into EBIT margins also. That scale will be not 0.4, but maybe slightly higher than that.
Thank you, and best wishes.
Thank you. The next question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Yeah, hi. Congratulations on great listing. One is on when we talk about premium products, we are just talking about air models, or it also includes some of the X.
Sir, sorry to interrupt, but the line is not clear. We're getting an echo from the management line.
Yeah, management line is not clear. You're right.
Sir, I think you can proceed, sir, with your question.
Okay. So, no, so I think we just separate the mic and all of that from our system. The echo doesn't matter. So where is the mic? Just as far as you can. No, so I understood the question. I think the question is, what do we classify into premium and what product do we classify into mass?
Right.
So premium is Air and Pro, and mass is X, or all the variants of X and X plus.
Got it. And when we are referring to PLI incentive in one case, it would be only on Pro and Air, right? Not on the X series yet.
Yes. Yeah. And we've applied for the X series also for PLI incentives, and I think we're almost maybe this week or next week we will get all the certification and all is pretty much done. Yeah.
Got it. And we have talked about motorcycle launches, which we'll be talking about tomorrow. But how do we see our scooter portfolio? Are there any white spaces which are still there, which we are not yet catering? How do you think from that perspective?
Yes. So, if you look at the scooter market, that's a good question. We have a portfolio in terms of price points, from almost 75,000-80,000 to almost 1.3-1.4 lakhs, right? So we have a broad scooter offering. In terms of style, we have largely one style. There are some style white spaces like sports or bigger format scooters, touring scooters, etc. We have that in our mind, but nothing in the short term that we plan to launch. Our focus right now is motorbikes. But maybe in due course, we will make some announcements in that direction.
Got it. And lastly, can you talk about your net debt as of June and maybe currently post listing, post IPO proceeds?
So as in June, our total approximate gross debt would be around 2,800, and the gross cash in hand would be around $1,300.
So that is June, pre-IPO.
This is all pre-IPO. This is June 30th data.
Yeah, sorry, June you said 37 to 3,800, 3,700.
2,700 to 2,800 debt.
Okay, got it. Okay, great. That's all from my side. Thanks and all the best.
Thank you. The next question is from the line of Amin Pirani from JP Morgan. Please go ahead.
Hi, thanks for the opportunity and congratulations on the listing. I had a question on, the buyer of EVs, because you sold so many EVs. I don't know if you tracked this, but broadly, do you know as to, most of your buyers, are they first-time two-wheeler buyers or are they upgrading from a certain kind of product? Some insights there would be quite helpful.
Is that Amin?
Yes.
Yeah. See, the buyer has obviously evolved from 3 years ago to now. 3 years ago, when the industry when we had just launched our first product, PS1 Pro Gen 1, the buyer was largely the early adopter, the slightly younger, urban, affluent buyer. Now, actually, because EV penetration in scooters is 20-odd%, our market share is fairly significant. We sell across the country. We have 700-800 stores across the country. So the buyer profile is now fairly diverse. The premium products like Pro, especially the Pro, which is a absolutely high-powered vehicle, higher than many 125cc motorbikes also in terms of power and torque. That buyer is a slightly more involved buyer who maybe an affluent student, college student, or maybe a first jobber, a little more urban focus on that product. As we have brought in S1X with the 4 kWh especially, we've seen a lot of delivery riders, etc. in urban centers start to buy it. Another interesting nuance is, when the last I visited the stores, I saw a lot of women buying our scooters, with a very interesting insight that they actually find EVs much more convenient than petrol, because they don't have to go to petrol pumps to fill it. They can charge at home, and for women, these are interesting considerations in buying vehicles. So there are some buyers I've met, again, anecdotally here, have moved from ICE premium bikes into EVs because they find those bikes bulky for cities, but they wanted a higher powered vehicle and they wanted an EV. So it's now a fairly broad spectrum and increasing penetration into upmarket, upcountry markets also, as well as deepening penetration into urban centers like Bangalore, where it's the it's going deeper than just the upwardly mobile buyer.
Okay, great. That's helpful. Second question is on your cell usage in your own vehicles. Sorry, I think there's an echo.
Sorry about that, guys. We will control.
Can I go ahead?
Yes, please.
Yeah. So you mentioned that from 1Q next year, we are going to have our own cells in our vehicles. Now, initially when you ramp up, should we be prepared for maybe a negative hit on gross margin and then an improvement? And because you are mentioning that as one of the areas which will lead you to a higher gross margin, maybe over a period of time. But in the initial quarter, should we be prepared for a negative hit when that happens?
I think on the gross margin level, firstly, actually, the reason we have shared segment with you also is so that you can appreciate the two business evolutions separately, as many of you have questions across individual segments. So the automotive, as I mentioned, will continue to incrementally improve without the cell also on gross margin through many, like I covered that. On the cell, at a gross margin level, I don't foresee a link to scale as much. With scale, we will improve gross margins, but the negotiated supplier BOM costs that we've gotten for our cell are fairly competitive, I would say, compared to the procurement of the full cell. There will be a different curve on the EBITDA consolidated EBITDA margins because the cell will take some kind of fixed costs and a minimum volume before the EBITDA margins start turning consolidated level better. But it will also be set off by the improvement in EBITDA margins on the automotive side through this period. So we are today not giving very clear timelines on when the consolidated EBITDA or profitability breakeven happens, but actually gross margins should see continued improvement with the cell also. EBITDA margins, there might be a twin action. Automotive continues to improve. Cell might have EBITDA margins reaching to breakeven at a slightly higher volume than 1.4 gigawatt.
Understood. And if I can just ask one last question. If I look at the segmental breakup, on the EBITDA level, there is a, reasonably large unallocated part out of the overall EBITDA loss. So maybe Harish can help us understand what that unallocated is.
So let me actually take them, Harish, you can add if I miss anything. So if you look at the unallocated, I think for Q1 it is 70 odd crores, 75 crores.
Yeah.
So of the overall revenue, it's about 4 odd %. So it's in, roughly when we analyze other companies on who report segmental and their unallocated expenses to revenue, it's roughly the median range of cost to revenue. Now obviously we have an EBITDA loss, so as a ratio of loss, high. But largely these are, if it's for 25 crores a month, these are largely corporate costs, corporate teams, finance team, etc. For the corporate office costs.
Okay. Understood. Thank you and all the best.
Thank you. The next question is from the line of Amit Hiranandani from Smiths Limited. Please go ahead.
Thanks, team, for the opportunity and congratulations for showing good improvement in the operational performance. Sir, from here on, your first priority and focus will be to improve margins or to keep gaining market share. Also, sir, do you see more price cuts or price reduction post using your own manufactured cells?
So Amit, firstly, thank you for recognizing the improvement in margins. So you were the first one on the call, so really appreciate that. The team has worked hard to, and then the whole team, not just Harish and I present here, but the whole team has been, along with on parallel the IPO, we've been hard at work to make sure we continue to grow as well as improve the bottom line. Now, looking ahead, our focus is to deliver profitable growth. So in terms of pricing, we will we will keep tactically using pricing levers as long as our overall focus on improving profitability continues. Now, how that plays out in different markets, across different products, across different times of the year, some seasonal sales, etc. That, like I said, is a tactical decision for us. But the focus is to build margin or build supply chain strength through vertical integration, build technology in-house to bring margin in-house, and pass some of that to consumers while improving the general direction of gross margins. Now, with the cell, like I mentioned in my previous comments, the gross margin will improve. How much of that we pass on to consumers, we will take a tactical call at that time. But our focus remains on profitable growth and continue to focus on penetration with products as well as with the right pricing for the consumer.
Sure. This is very helpful. Sir, my second question is basically how much gross margin improvement one can expect once we use all our manufactured cells. And continuing with that, sir, on the cell manufacturing plant, how will be the arrangement between both the companies? At what margin sales will happen to Ola's two-wheeler?
See, the sale between the companies will be an arm's length transaction, although both are subsidiaries of the parent company itself. So at a Concall level, obviously, you will see the overall benefit. But it will be at an arm's length. Whatever price you will be able to procure this cell externally from a vendor, you will be able to we will price it like that. On what was the first part of your question, Amit?
So how much gross margin improvement one can expect once we see all our manufactured cells?
See, on the gross margin improvement from our cell, if I just give you, I won't be sharing the specific maths today, but if I give you a way to think about it, the cell is, let's say, 30-35% of the overall vehicle cost. And globally, companies make about, let's say, companies like LG, CATL, etc., depending on the markets, but between 15-25% margins on the cell business. And this is on a global pricing. In India, the average pricing of these companies is slightly higher than the global averages, given the smaller scale of the Indian market. Now, you can assume, because we are manufacturing for now only for ourselves, we don't have a large corporate team in the cell business. So the margins that an external vendor makes, we will actually be able to save that at a gross margin level soon enough. And there's a 5% duty also that India charges, so that also will be saved. So you can assume that that's the rough way to think about it. 30-35% of the cost of the vehicle is the cell, and in the beginning there will be a certain gross margin saving, and as we increase our scale from 1.4 to 5, further our BOM cost will reduce due to higher volume, and you will improve your gross margin savings.
Yes, sir. The last one question, sir. Basically, we wanted to understand more on the your export strategy, the target markets, and what is your strategy for the growth over there. And secondly, lastly, bookkeeping is on the capex outlook, if you can give for the next 3 years. That's it. Thank you, sir.
On the export markets, India is actually a very strong exporter of two-wheelers to the world, and the ICE industry, and kudos to them, they've actually built a very strong global profile for Indian two-wheelers. In EVs, I actually believe India has an opportunity to become the largest e-two-wheeler producer in the world and the largest exporter of these across broadly the global south markets, be it ASEAN or Africa or Latin America or even parts of Europe. Our focus will be these markets. We're not entering any of these markets in the absolute near term, but it is on our medium to longer term roadmap.
And the capex outlook, sir?
On the capex outlook, you see primarily both the projects, both on the auto side and the cell side. Auto will consider the capacity expansion and augmentation at the right time and raise the thresholds of our existing capacity. So that will be one capex will occur. And the other is on the cell side. I think we discussed on the call that we are currently in the roadmap of going up to 5 and then 5 to 6.4 and then 6.4 to 10 and beyond. These are the broadly large areas where there will be capex, other than some sustained capex on existing processes, etc. These are the two areas where there will be investments in the next 2 to 3 years.
Okay, sir. All the best, sir. Thank you.
Thank you. The next question comes from the line of Pramod Amte from InCred Capital. Please go ahead.
Yeah, thanks for the opportunity. So the first question is with regard to the new cell which you plan to manufacture. It's interesting to see the high energy density which you are planning to pump in. But wanted to understand your thought, is it to reduce the range anxiety of the customer, or how are you looking at positioning this cell in your product line?
Pramod, the cell is the heart of the EV. Just like in the ICE vehicle, the engine was the heart of the vehicle, right? The cell is a constantly evolving technology, and that's why in the last 4 years we have invested a lot of time and energy, and my own personal bandwidth has gone into creating this cell technology in-house, and which you see in the 4680 cell that we've now made. The benefit of building this technology in-house is, many features or performance metrics of the vehicle are controlled by the cell. For example, the range that a certain cell capacity can offer, the amount of weight that your battery pack has, lower the better. That means the energy density of the cell matters. The charging time depends on the cell technology, not the charger. It depends on what kind of cell technology it is. And then the cost also, there's a lot of innovation in the chemistry that you can do to bring down cost of the cell. All of these we have, and also to make it more relevant from a thermodynamic perspective for the Indian market, the Indian environmental conditions. All of this we have done. So that's been our focus, and as we bring these into our product, it will definitely improve the product experience for consumers in terms of a lower weight, a product and higher range, slightly faster charging time, etc., etc. And with every subsequent generation of the cell in the next few years, each of these metrics will keep inching upwards.
Sure. And the second question is with regard to broadly, what's your thought process or expectation from the FAME policy, since you have been a beneficiary of the same, and with that you have been now being able to put up a very strong foothold for the company. I'm asking you in the context that post the FAME subsidy is off in June, you have improved performance, and if I further dice it between premium and the mass, my sense is premium is already making a bit of break-even or profits. So how do you look at FAME incentive? Should it continue? What are the benefits you would still look at going forward?
Actually, that's a good point, Pramod. Again, kudos to you. You're the first person to highlight that. The premium products are obviously better compared to the mass products, fairly profitable. I will say profitable, I will correct my words. It is much better in terms of financial performance, and premium, the cost across the two products obviously is different. Battery sizes are different, electronics are different, but premium, we are able to price higher also and monetize them better. Profitable or not profitable, I don't want to comment on that today. I think that will be a little too much information for today. On the same point, the government has been fairly clear directionally that they will taper down the same subsidy over time. And already in 1.5 years or so, it has gone from 60,000 rupees a vehicle to 10,000 rupees a vehicle. So FAME is actually not that material in the larger scheme of things of the industry. I think the support is needed by the industry for another year or two, because 10,000 is still useful, about 7, 8, 10% of the overall vehicle value, still useful in terms of meeting the cap on profitability. But the industry is continuing to innovate, so we are continuing to innovate. So I think even if this level of FAME support continues, the industry will continue to grow well.
Sure, thanks. And the last question, if I can ask, looking at the two-wheeler industry profitability, which ranges from the part of double digit to some are in a higher double digit, and considering at one end you want to be profitable, and the other end you are on a mission to drive EV penetration in the two-wheeler space, where is your ambition or balanced profitability margin? How do you look at it, or should we look at it more on ROC basis? How do you look at the business?
So if you look at our automotive segment EBITDA, and it's in the presentation that we also shared, you see, I'm just going to read out a few quarter numbers for you. Last 4 quarters, Q2 was negative 32%, Q3 was negative 10%, Q4 was negative 7.5%, and Q1, which is this quarter we're talking about, is negative 2%. So the automotive EBITDA margins have consistently improved for us in a period of reducing the FAME subsidy. And this has been driven by, like I said, the vertical manufacturing strategy of ours, vertically integrated manufacturing strategy, as well as the core technology development in-house of all EV-centric components. Now, these two themes will continue over the next couple of years. Long term, I believe EVs will be a very similar profitability number as ICE vehicles. Because like I said in the beginning, thematically, ICE vehicles are only getting costlier due to compliances, and EV vehicles are only getting cheaper due to the battery cost curves, the learning curves of the battery costs. So at what point that inflection happens, I'm sure all you analysts have your own models. I have my own. But in the next few years, not long far out, we will all be here, I believe, when it happens. Be here, and maybe we'll be doing a call together in the next few years, and that would have happened. Actually, already, if I just give you some macro commentary, in China, you're seeing that happen where EVs are now cheaper than ICE vehicles. Now, if China is there, the global supply chain for many of the input materials like lithium, etc., are common. As we scale up some of these manufacturing capabilities in India, and as we get some more scale of product volumes in India, I believe the same dynamic will come through in India.
Sure. Thanks a lot, Mr.
Thank you. Ladies and gentlemen, we will take that as a last question for today. I would now like to hand the conference over to Mr. Abhishek Chauhan for closing comments. Over to you, sir.
Thank you so much. On behalf of Ola Electric, this concludes our conference today. Thank you so much for joining us, and you may now disconnect your lines. Thank you.
Thank you. On behalf of Ola Electric, that concludes this conference. Thank you everyone for joining us. You may now disconnect your lines.